In this presentation, we will take a look at the concept of ordinary and necessary trade or business expense. When thinking about whether or not a business expense is deductible, we need. For more accounting information and accounting courses, visit our website at accountinginstruction.info. To have it be in accordance with these terminologies, ordinary and necessary, in order to be deductible on the Schedule C. Ordinary are expenses that are customary or usual. So these are going to be expenses that we would expect to see in the type of business. These are going to be the customary, usual expenses within that type of industry, within the trade or business. Then we have the concept of necessary. So ordinary and necessary. Necessary expenses that are appropriate and helpful rather than essential. So that's the condition we need to meet in order to have the deduction. We need to have it be appropriate and helpful, not necessarily meeting the criteria of being essential in order to take that deduction for the Schedule C. We also then have the concept of reasonable. So in addition to ordinary and necessary, we have a later addition of reasonable. Expenses must be reasonable in amount and reasonable in relation to their purpose. The concept of reasonable is one that we might think would be done by the market. In other words, we would think that we wouldn't have an excess expense if there was a market transaction and we didn't have related parties. In other words, we wouldn't pay more on an expense in order just to get the deduction. If we were to pay for something in a free market, we would pay whatever we could in a negotiated price, typically leading to the lowest price. Now, this won't be the case sometimes if we were to have transactions that were related party transactions, and that gets into different types of issues. If we had a related party transaction, it might be the case that we pay more than we would expect for some type of transaction because maybe there's some benefit other than just the negotiated transaction. Maybe there's some kind of gift or something else going on there. So that's when we would think that you would have some kind of distortion, paying more for something and then trying to write off basically the expense for that payment. So reasonable is in essence kind of a double check on that market in some ways. We can think of it, well, they're trying to check if the expense that was paid for was excess. It shouldn't be excess if we're seeing that an excess amount is being paid over and above what would be normally a reasonable type of payment. Then this is just giving some more kind of authority to look into that possibly, because that shouldn't be the case in a free market transaction. And if that's the case usually, then you would think there's something else going on, like a related party transaction or something like that. Now, there's going to be some expenses that are not going to be deductible, even if they're ordinary, necessary, and reasonable. So they're going to be basically forbidden. The tax code's going to say, hey, you can't do these things. And of course, most of those things are going to be bribes or some type of illegal payment. So a bribe or an illegal payment may be ordinary, necessary, and reasonable, but it's not something that can be deductible because it's an illegal type of payment, so it can't be deducted on the tax. And lobbying and political expenses, those are things that typically the tax code doesn't want to encourage, I guess, is the rationale there. So any kind of lobbying or political payments not deductible. Fines and penalties. The point of the fine is to give a fine, a deterrence, and so the idea of having a write-off for it is contra to the incentive, the government incentive of the fine in the first place. So I think that would be the rationale to say that fines and penalties are not going to be deductible for taxes typically. For more accounting information and accounting courses, visit our website at accountinginstruction.info.